Hi guys, so today's topic is going to be AirAsia. If you've been following my blog, you know that I'm a little bullish on AirAsia. You can actually go to my blog, right? It's a pretty old article. I wrote it in, I think, September. So it's this one, right? AirAsia buy or die. So you click it. This was like a presentation I did for some friends, so that's why it's in a PowerPoint format as opposed to an article. But yeah, you can go read it for the thesis on AirAsia. But today's topic is going to be a bit more specific because a friend recently asked me how I felt about AirAsia today, right? What are their prospects? So notably, they just had an EGM today because they were trying to get shareholder approval on an employee ESOP scheme, employee share compensation scheme, as well as an acquisition of one of the digital businesses from a full acquisition of it. So so the topic came up, and some people are asking me how what was the runway for them. So that's why I decided to do this, and the reason why I'm doing it as a video rather than an article is because I wanted to test this format out, because it's a lot easier for me to do an analysis using my voice rather than typing it out and editing, right? That editing takes a long time, not to mention typing it out. So I'm going to try this format. If you guys like it, then I'll consider switching over. And also, I'd like to apologize for the fact that the mic isn't very good because I don't have a good setup. So if I get enough interest, then I'll consider buying a proper mic. But just bear in mind that this is a regular headphone mic, so it's not going to be the best quality streaming. Okay, so regardless, let's just get into it. So I guess to start with, we can just look at their cash, right? So as most of you are aware, AirAsia there's bankruptcy risk on the horizon because because of COVID, right? Quite obviously, they're not really flying, and in Malaysia in particular, we are having a lockdown because of about a month back it's quite a severe rise in COVID cases. I'll spare you the details because that's not what I'm going to, but you can Google it or something. So maybe one thing you might want to have context in advance is that their bread and butter is domestic Malaysian flights as opposed to international flights. So if the government lifts intra-border lockdowns or domestic lockdowns, they can fly again, just like they have in the second half of FY20, correct? And so they're not as badly impacted as if they were, for instance, Singapore Airlines, which relies almost completely on international flights. So I'll spare you details. You can go and read about the business model in this article, right? So but now I just want to answer the question which my friend posed, which was, how much more runway do they have? Specifically, how many more months of runway do they have, right? So okay, with that said, let's begin. So you can see that they have roughly 400 million of cash, 800 million of borrowings, plus 289 million. So I've done a small Excel spreadsheet. So we're mainly trying to find out what's the cash runway like, right? So it's mostly that the prominent line items would be cash, right? Borrowings, of course, because that's the bankruptcy risk, and of course the lease payments. So lease payments are similar to borrowings, right? If you follow IFRS 2015, or I forgot what IFRS was, right? Yeah, so they pretty much had borrowings, except that because it's an airline lessor as opposed to a bank, what the lessors have been doing so far is giving them some forbearance, so stretching out these payments, giving them some more time to survive, more liquidity. It's not as bad as a borrowing. The worst that can happen is they take back their planes, which is also a going concern risk, but it's not equivalent to bankruptcy risk, right? So yeah, so again, the goal is to find out how many months of cash runway they have remaining. So as we've noticed, they don't have a lot of cash left. They have 1.2 billion in 1.3 billion borrowings, total borrowings. Notably, a large amount of 1 billion ringgit. So these are all in ringgit, right? Ringgit Malaysia, not USD. Let me just make it easy for you to see. So, right, ringgit Malaysia. So they have lease payments, short-term leases of 3.2 billion. So I guess what's relevant is really the short-term borrowings and short-term leases, because that's the liquidity issue, right? That's the source of the liquidity issues. And they also have these interest payments. So we're trying to find out how many months. So yeah, you can actually see they have like 7 months left, right, according to my estimation. But let's break it down. So short-term leases. Okay, so the reason we'll go to their FY20 annual report to gather insight, because that's where you can see an example of a full year impact of cash flows, right? Cash outflows. Keeping in mind that they're not really having much cash inflows, at least not a sustainable amount, right? Look at their revenues; it's 3 billion in 2020 versus nearly 12 billion in 2019. That's like almost a 4 times difference. Oh, sorry, 25%. Kind of gap kind of thing. So clearly they don't have the cash. So how many months of runway do they have? Okay, so we can see that their OCF is negative 2 billion, right? So that's a lot, which means, so as opposed to 2.5 billion positive, now it's 2.1 billion negative. So clearly, if you only have, right, about 500 million of cash, that would imply 1/4 of cash runway. So clearly that's not good. So I just want to highlight a few of the major line items you should be looking at. So the first one would be this one, amounts due to subsidiaries, associates, joint venture. It's basically intercompany balances, right? It's the cash flow between companies. So it's about 1 billion, right? I mean, if you want to be conservative, you just take the full amount, right? Not including subsidiary netting loss. So notably, they have a lot of associates in ASEAN because of the ASEAN Open Sky policy, where basically, if you want to skip the entire, get a license to operate an airline in a different ASEAN country, you can just partner JV with an existing domestic airline, for instance in Thailand with a Thai airline. So you don't need to go through the whole hassle of acquiring a new, an entire new license in that country, which was actually one of the highlights for the GMT research report. There was accusing them of accounting shenanigans in 2016, I think, or 2015. So the associate structure that was prevalent throughout Asia was basically the linchpin of the argument. But I think maybe at the time this wasn't public information. So because ASEAN Open Sky policy was created not long before that. So with the benefit of a few years of hindsight, I can say that the associate operating structure that GMT was concerned about, right, may not be that concerning. But anyway, I don't want to get into it. So just know that they're basically, raising funds at the group level and helping the JVs around ASEAN. And it's not just ASEAN; they also have, entities in India. So let me show you. Okay, so right, yeah. So Malaysia, Philippines, Indonesia, Thailand, India, Japan. So these are ASEAN, and these two are not. Notably, these two have been closed down, right? So let me show you here. So they've sold their Indian JV stake. Basically, it's negligible right now, and the Japan stake has been, liquidated, or is about to be liquidated. Yeah. So that's really the bulk of the cash flow issues, right? It's a working capital. I wouldn't call it working capital, but it's still not really operational, not fully operational in nature. So it's this 1.3 billion is the one you want to be worried about. So, like I said, they have short-term leases of 3.2 billion to worry about, instead of short-term borrowings of 1 billion to worry about. So you add up, that's about 4.2 billion of cash outflows to be seriously worried about. Like this one, the lessors might give them some leeway, but they've already given them leeway for a year. You depending on your conservativeness in assumptions, you can determine how much you want to adjust that by. But let's just go with it. So basically, it's 1 billion plus 3.2 billion, 4.2 billion. So I'll just refer this as a mandatory cash outflow for FY21. So mandatory cash outflow is 4.2 billion, and we can see we can actually see the benefits that they have gotten from lessors, right? So these are the balance sheet figures, right? And you can see that from 2019 to 2020 FY, the difference is negligible. It's almost break even, right? Whereas borrowings, okay, they clearly borrowed a large amount, 860 million, to fund their working capital, right? Their liquidity for FY20. Having said that, we can see that lease payments, the net lease decrease, which is the lease interest amount, some added together with the lease repayments, right? So let's just call this lease repayments. Is negative 300 million. So that's not too bad, right? Something that's well contained within the borrowings amount. And the net lease decrease, right, from 19 to FY19 to FY20 is it's almost 1.3 billion ringgit. It is not USD, it's ringgit. So that's a substantial amount. So we can see where their operating cash flow is coming from, right? It's mainly from this is not operating cash flow, where their liquidity, where their cash flow is coming from. So it's 1.3 billion. So right, a substantial amount is coming from net lease waivers or forbearance, whatever you want to call it. So basically, the lessors are giving them time to repay, right? Giving them extra time to repay the leases, right? And we can clearly see that in the lease amounts increasing. So right, from 12, not budging, right? Despite the fact that there would be a transfer of leases, so there will be an increase in the amount by 578 million. So the way the accounting works is that when you're in FY19, right, you will debit lease interest, right, lease interest expense of 578 million, and you credit that to short-term leases, right? Credit short-term lease or long-term lease, I don't remember. Regardless, it will come in here, and then you will debit the lease payments and credit the lease repayments, right? Sorry, you'll debit the lease repayments of 880 million and credit it from cash, right? So this cash amount, or rather, this cash amount is basically net of the 880 million. So that's how you get the final loan balance, the lease balance, right? And then there will be movement between long-term and short-term leases, but for liquidity purposes, that's not so relevant. So basically, we can see very clearly here that their funding for FY20 has come from total borrowings and lease forbearance. Okay, so that's, if you ask me where FY21's cash flow is going to come from in the absence of business, right? Actual planes flying in the air and fetching customers around, it's probably these two. That's the context. Okay, so that's how much money they raised. What about how much money they expensed? The actual cash outflow as opposed to profit and loss expense, right? And accounting expense. So it's roughly 1.3 billion. Bearing in mind that these aren't accurate, precise figures. These are most likely, at best, they can be considered estimates. But given some margin of safety, margin of error, say 20% to the upside and downside, that's your rough estimate, right, of what the operating cash outflow is like. So the context of operating cash outflow here is that this is the estimated full year liquidity impact to 2020, and I think we can safely estimate that that will be FY21's impact as well, because now everyone's getting their vaccines. I think Malaysia is expected to reach probably 50% vaccination. Don't quote me on this, I might be wrong. Or by the end of the year. So by then, people will start flying domestically again. A bit like what the US and China airline recovery right now, airline sector recovery right now. So, right, if you want to be, I think a conservative will be a repeat of, a conservative estimate will be a repeat of FY20's negative cash outflow. So this is the amount that they need to overcome, right? They need to raise to survive. And notably, you can see it's mostly intercompany cash flows, which I showed you just now. Right? It's this one. So it's not really this one, right? It's mostly this one. Because yeah. Alright. So okay. Oh, I'm sorry. This one is wrong. So this one should be 2168. Okay. So that makes things a little bit different. So which means the operating cash outflow was 2.1 billion, right? And half of it was intercompany movement of cash flows. So basically, they subsidize their subsidiaries in the other countries, or rather associates in other countries, to the tune of about 1 billion. So the other 1 billion was through group expenses, okay, consolidated group expenses. So they had investing cash inflow of about 500 million. So we can see where it comes from. It's a disposal of an associate. I haven't actually checked this. Actually, we can check this now. Okay, I'm going to spare you the time, right? Actually going to the details because I don't want to bore you. But it's likely one of these, right? Either AirAsia India or AirAsia Japan. So okay, so that's an unusual amount as well. This 134, sorry, this 152 million. This 134 million, it's so okay. So if we go to leases, 256. So the leases are leases of aircraft and spare engines, long-term leases. So these are basically borrowings from GE or I don't know, right? I mean, I'm not an aviation expert. I have to guess it's probably some sort of lease with aviation upstream party, and it's a long-term one. So I struggle to imagine why it's a cash inflow, but let's just go with it, okay? Acknowledging that that's part of the liquidity income. And as you can see, these cash flows of negative 900 million. So you net all of them off, right? It's the sum of it. That's about negative 2 billion of net cash outflows. Okay, so what's this? Yeah, alright. So so which means they actually had negative 2 billion of net cash outflows. We can see that these amounts, okay, yeah, these amounts are basically operating cash flow plus investing cash flow plus financing cash flow. That's the net drain of cash, right, during FY20. So the steady state cash flow assumption will have to add, right, you have to add back the net lease forbearance that were given to by the lessors. The net lease decreases because that amount is relevant to estimating what their maximum net cash outflow might be in FY21. So you get something like 3.3 billion. Okay, so this one is wrong. Okay, never mind. For the purpose of time, let's just move on. So they actually raised an equity issue, right? So it's a prominent Hong Kong businessman, Stanley Choi. I think he runs some sort of I'm not sure what business he's in. Can't remember, but he's a wealthy guy. So that's 330 million. Where is that? No. That's in FY21. So, right, you can see cash flow. Here, proceeds from issuance of shares, right? So that's 336 million. And they currently have cash. So that you add that to cash. Now that is included in the current cash balance of 447 million as of 21Q2. Okay, this is 21Q2. So the earlier report was FY20. This one is 21Q1, not Q2. Okay, so the question now, so we know that they have 400 and let's call it 500 million for convenience, half a billion of liquidity, and they need negative 3.3 billion on the steady state assumption of cash outflows, and negative 2 billion if the aircraft lessors are willing to give them extend the same level of forbearance as last year. So I'll just qualify by saying that I'm not 100% sure what the level of forbearance will be, but it's likely going to be, I think the aircraft lessors will roughly give them the same, right? That's the business model. During bad times, the aircraft lessors serve as that buffer for the entire industry, and they're more likely and not well capitalized. So I mean, you can adjust this if you want, but I'm just going to go with it. So they need roughly negative 2 billion. So compared to 500 billion, right? That's that's a huge amount of difference. So okay, I think I know what this is. Right. Give me a second. So 3.4 or whatever equals 1.5 divided by 3.4. Alright, so we can see that. So okay, there's another. So we can see that they have very little cash left, right? About 500 million left before they run out of cash. But good news is that they have a pending syndicated loan, right, to be guaranteed by the Malaysian government, Dana Jamin, which is basically a quasi-government entity. They're basically a credit derivative guarantee kind of entity, right? So it's like AIG during the global financial crisis in the US. So so they basically guarantee your loan, and then you get a higher rating for it. So in this case, they're reported to get 1 billion loans, and this was news. This isn't news because even back in September when I did my previous analysis, right, this one it's already noted here, right? Yeah, 1 billion. Okay, whatever, right? So basically, 1 billion is pending, and it's been in the works for a long time. So you can interpret both that two ways, right? One is that it's probably coming soon. The other one is that it's worrying why it's been taking so long, right? It's about almost a year already. So it could be an issue. But anyway, if we assume that they'll get the loan, so basically they have 1.5 billion of liquidity in terms of cash runway before they face a cash crunch. So we have 1.5 here, right? You can see that that's the formula. 1.5 divide. So this one has to be changed too. So if we assume that they have a cash outflow of 2 billion, let's call it 2.1, right? So this one is actually closer to 2.1. So which means that they have, give or take 8.5 months left of cash runway. So it's currently end of June. Let's call it July, August, September, October, November, December, January, February. So call it February, right? February they'll go bankrupt. Whereas if you assume that the lessors will not give any more forbearance, that's the worst case scenario. It's only 5 months, so we're calling end of the year. So basically, the worst case scenario is that they run out of cash by the end of the year. So which is not good. So to my friend's question about how long more can they survive, right? How much cash runway do they have? My answer would be, end of the year at the worst case, or February if you want to give them a bit of benefit of doubt. So I'm aware that 5.29 months isn't end of the year. It's let me just be sure. July, August, September, October, November. So it's December, right? It's end of November. But it's not precise anyway. It's all just estimates. So let's not get into the weeds. So to my friend, it's 5 months. It's end of the year at the worst case scenario, and February on the steady state scenario, right? Assuming no further forbearance by air lessors, aviation lessors. Now keep in mind that this isn't the end of the road for them in February, or let's say December. Worst case scenario happens, they go bankrupt. So just give me a second. So sorry about that. So even when they get to end of the year, they won't go bankrupt, right? They'll just have to dilute shareholders through equity. So keeping in mind they've already funded 330 million. If they wanted to fund again, I don't think raising equity funding for a company as prominent as AirAsia is an issue, but you definitely be diluting shareholders quite a bit. So the question is, how much is a bit? Okay, so we can see that so here's the dilution calculation. So the share price as of today is 92 cents. Equity funding to be raised. So it assumes that 1.5 billion of equity funding can be raised. Just give me a second. I got to. Alright, sorry about that. So if we assume they they were planning to raise up to 1.5 billion equity. So right now they've raised, as you can see, right, 336 million. Let's just get on this, right? So 336 million. So which means they have, according to the assumptions in this model, the dilution assumptions, they have probably about 1.15 billion remaining to be raised within the assumptions of this model, right? The dilution assumptions. So that at just give me a second. Okay, correct. That's right. So at 92 cents to raise 1.5 billion, that's an increase in the share base of 1.6 billion. The current existing number of shares is 3.3, which means the implied number of shares post-dilution. Let me just check what the, let's double check. So, by the way, this is the best website you can get in the Malaysian, for Malaysian listed companies. It aggregates all the information. So yeah, good place to be. Okay, so now it's 3.8 billion. So that's 3.812. Yeah, that's basically this plus this plus some random stuff. So let's just change this to eight. Was it 3.12? It's 3.12. Okay. So the impact number of shares post-dilution is about 5.5 billion shares. Okay. Market cap as of today is 3.5 billion. Right. So the implied share price post it's only 43%. Right. So post. Apologize for this, but as you can see, I'm amateur at streaming. So it's 1.3 times. So your implied market cap would be 5 billion, right, which is basically this times this. Whereas this is 0.92 times 43%. Your implied entry price if you bought today at 92 cents. And then so your implied market cap is it's really a round figure, it's 5p, so it's very easy estimate. The 10-year average net profit is about 800 million. And you can go dig out the figures yourself, 2010, 2019. So basically what you do is you take the 10 years of profit and you average them, right? I've actually got the numbers here, but just show you. Yeah, okay, so these are the figures. Okay, so 10-year average is 800 million, right? Then, so if you take the implied market cap of 5 billion, you divide it by 800 million, you get an implied post-dilution PE ratio of 6.3 times based on the average of historical earnings over the past decade. Right, so 6.3 times, right, so that's not bad. So that's basically steady state, basically zero growth kind of valuation, earnings multiple. What's this? Yeah, alright, so just ignore that. So it's 6.3 times, alright. So if you actually read my blog, right, I'm bullish about AirAsia because there's the ASEAN growth story, where ASEAN is poised to become next China. So we're going to have a population increase, right, and more disposable income increase over the next 30 years. And AirAsia is poised to become one of the dominant airlines because it's the lowest cost airline in ASEAN, right, on a US dollar basis. So there are many reasons for that, but you go read the blog if you really want to know, right? And what happens in the commodities industry is that over 30 years they merge. They eventually become oligopolistic. So that's when you get pricing power. But anyway, go read the blog article yourself, right? I just want to finish this up. So assuming they survive COVID, with this kind of growth potential, it's definitely not worth 6.3 times PE, right? So, which implies that this 6.3 times PE imputes bankruptcy risk, right? Obviously, bankruptcy risk is real if if COVID resurges like a third global wave. We have the Delta variant now. That's the second global wave. So if a third global wave appears and seems like it's going to stretch for 1 more year, the risk of bankruptcy is real. So what you can do is you hedge your position, right? So I actually discussed it here. So you can hedge the position because the bankruptcy risk is not zero. So just take a small position. I'll let you decide what the amount is. Maybe 5%, maybe 1%. That's up to you. But the upside, for a company with this kind of growth potential. So that's So we know that the earnings multiple, whether you're taking the P ratio or the EV DAR, is a reflection of the current risk reward of the business. So the risk reward, if they survive COVID, which means after COVID is over and they're clean, right? We know that they have enough liquidity to survive COVID with 100% certainty. The risk reward changes, right? So we don't know that now because we can't see the future. But assuming we get to that point, obviously the risk reward is going to change, right? Nobody's going to value a company which has this level of growth potential at 6.3 times PE. It's probably going to rate to closer to 15 times, right? Or even 20 times at the upside. So maximum upside. So this definitely reflects a very low earnings multiple. So basically, if they can get past 5 times PE, end of the year, without a resurgence of COVID, you're probably going to see yourself making double your money at 92 cents today. Right, then today's share price is, what's the share price? 92 cents, right? So yeah, that's basically it. So I'm bullish. So basically the thesis boils down to, is there another resurgence of COVID? Because as we know, the new vaccines, they will roughly, they're still effective at protecting against the Delta variant, right? So if you can get the world vaccinated by then, or even not just the world, if you can get ASEAN to a steady state pre-COVID airline operating scenario, then AirAsia's share price will probably double from 92 cents, right? Actually, so it's not really that hard to believe because pre-COVID, right? Pre-COVID it was already, where was it? Okay, pre-COVID was here, right? So I know some people have some concerns about the Airbus and scandal and the GMT scandal and accounting fraud and stuff like that. I'll admit I'm not imputing any of this in my analysis, so that's up to you. But right, pre-COVID, that's the post switch from airplane ownership to airplane lease business model was 1.7, right? So 1.84, which is 0.92 times 2, it's not that much of a stretch. So okay, it won't be 3 or 4 because this is when they still own their planes, right? Yeah, so that's it. So maybe I'll just end with some miscellaneous notes. So if we look at their segmental, 263. Yeah, so where is the money in this 1 billion amount going? Where's the 1 billion? Yeah, this one, right? Where's the cash outflow going? I think it's Thailand. So okay, it's probably India and Japan because they're perpetually loss making. So yeah, just give me a second. So there are actually some good YouTube videos which I can link to understand the the operating environment of India. Japan, I'm not too sure, but anyway, it's small. India is really a really competitive environment. It's very different. Like for instance, for some reason, the fuel expense is 34%, 33% of total operating expenses, whereas the global average is something like 24%. Right? So there are some nuances in the Indian market, a lot of nuances in the Indian market, which makes it logical for AirAsia to get out of the Indian market. So Indonesia is a little bit unique in the sense that it's a very cutthroat market. It's a really big market because they have 270 million people. So that's like double of Japan, and it's a growing market. It's clearly an emerging market, but it's a growing market. But the environment is really cutthroat for many reasons. I'm not going to go into it now. But I would imagine the bulk of the loss, the 1 billion here, intercompany cash flows is because of Thailand. right? So it's 1.3 billion of losses, namely because as you can see, this is likely a subsidiary, right? Because revenue is so much more than the other associates. It's more in India, it's definitely a subsidiary, and the fact that they're consolidating the depreciation to show that they own their planes, and the fuel expenses is high. Yeah, this is definitely a subsidiary, they're consolidating books. But you can see that Malaysia is definitely the bread and butter, right? So negative 3 billion of losses, whereas in 2019 it was 3 billion in profits. I don't want to go into a detailed analysis, but that's about it. So I hope you enjoyed this. Maybe give you some information on the context so that you can so this is the accounting context so that you can assign your own understanding of the business environment, right? The underlying reality of the numbers to determine whether you want to buy or sell. Good day, have fun, hope you enjoyed it.